Welcome to Investing 101. My name is Nat Kellogg. I'm the Director of Manager Search here at Marquette Associates, and today we're going to talk a little bit about active versus passive management. On this episode, we're going to answer the question, what exactly is an index? We're going to talk about a little bit about what the differences are between active versus passive management, and then help explain why a client might use one versus the other. So what is an index? An index is a basket of securities used to represent a market. In this example, we show you the S&P 500, which is a basket of securities, i.e. stocks, that represent the broad U.S. stock market. Now, there are a couple of important key criteria to make a good index. First and foremost, it must be replicable and investable. Investors should be relatively easily and cheaply able to replicate the performance of the index. It also should be broadly representative of a given investment universe, i.e. if it's meant to represent the U.S. stock market, when stocks go up, the index should go up. When stocks go down, the index should go down. And lastly, it must be maintained. Over time, companies IPO or go bankrupt, and so you must have maintenance of the index. This shows a representative list of indices that are often used in client portfolios. As an example, if you look to the far right, we show you the MSCI ACWI Index or MSCI All Country World Index. This index is representative of all large cap stocks around the world. It is a global index with $53 trillion in total market value. There are 2,774 underlying securities in the index today, and it is maintained by MSCI, a common index provider. So what is active and passive management? Given that we now know what an index is, passive management's role is primarily to meet the return of the index. The return tends to be equal to the broad market index that is tracking. The approach is to basically own the same securities with the same allocations as the index that they're tracking. And the benefit of this approach tends to be lower cost. Active management is picking a subset of securities within a broad index with the primary goal of outperforming that index over time. The primary benefit to this is that you can outperform the index, and the primary risk is that it's higher cost. So what does active versus passive management look like in practice? What we show you is the top 10 holdings in the S&P 500. And we show you there in that first column is the S&P 500 weight. This is the weight of these securities in the index. If you look at the far right column, this would be a passive index manager allocation to those same securities. You'll notice they are incredibly close to the weight of the benchmark or the index. Conversely, if you look at that middle column, you can see an active manager weight. So in this example, the active manager has decided not to own Apple and has a significantly larger allocation to Microsoft than both the benchmark as well as the passive manager. So why might someone choose active versus passive management? One of the primary things we look at Marquette is where's the greatest opportunity to outperform. So in markets that are more liquid, where information is more readily available and there's significantly more analyst coverage, markets tend to be more efficient, which means there tends to be less mispricings and it's oftentimes harder to outperform. This is oftentimes what we see with US-based large cap stocks and even US mid-cap stocks. Where we see greater opportunities to outperform are in markets with less liquidity, where there is less information and less analyst coverage. This oftentimes leads to greater mispricing and more opportunities for active managers to add value. We oftentimes see this in markets like international small cap, as well as emerging markets. So what is the primary benefit and risk associated with active management? Primary advantage is you have the possibility of outperforming the index. There's also the ability to own securities that are not currently in the benchmark, i.e. companies that are recently listed, i.e. new IPOs that have not yet been added to the index. What are the primary disadvantages? Higher fees and operating expenses. If managers can outperform, they can also underperform, making mistakes. And in broad perspective, active management is a zero-sum game. So if one manager is outperforming, another manager is underperforming, which creates a risk to investors. So why might someone choose passive management? The primary advantage is that the fees are incredibly low. In addition, there's a high degree of consistency. Passive funds are able to meet the returns of the index. What are the disadvantages? Meeting the return of the index is the best an investor can do. They're not going to outperform. In addition, not all asset classes that may be appropriate for client portfolios are accessible with passive management. I hope you enjoyed this discussion of active versus passive management, and thank you for watching.